Hello and welcome to the Master Later Life Lending podcast, where we explore the dynamic world of later life lending, equity release, and the evolving needs of borrowers over the age of 50. I'm your host, Paul Glynn, and I'm excited to have you with us today. In this episode, we're discussing strategies and solutions for managing mortgage debt into retirement, an increasingly important issue as more people carry debt later in life. Joining us today are David Hamilton from L&G, Nathan Waller from Family Building Society, and Will Hale, Group Director responsible for distribution at Key Group. Legal & General is a major financial services company offering a range of products to help manage retirement finances. A Family Building Society offers innovative financial solutions that are tailored to the needs of families and older clients. Will, David, and Nathan bring a wealth of experience and practical strategies that can help advisors support their clients in managing debt into retirement. Let's get started and welcome our guests, Will Hale, David Hamilton, and Nathan Waller. Will, David, Nathan, welcome. We've talked in the series so far in the other episodes about the need for comprehensive conversations and the way that they support better customer outcomes. There was a session on products designed to address emerging needs that we're seeing in the market, and a further session on technology and how that can support advisors tackle an ever more complicated market. So in this session, we want to deep dive the theme which has come through, that more customers are carrying debt into retirement. So really interested in your thoughts on that topic. So let's get straight into the question. So Nathan, coming to you first. What are the challenges of carrying mortgage debt into retirement, and in particular people's attitude to things like debt and inheritance?
So what we are finding, I mean, you only need to look at the statistics of that there's due to be over 26 million over 55s by 2039. So more people's attitudes towards maintaining and keeping that debt into retirement is becoming a bit more relaxed. Sometimes it's a necessity to keep that debt there. Sometimes it's actually looking at them benefiting the rest of their family, where they are passing equity down so that their kids and grandkids can maybe have a nicer home, a nicer property. But people are now more financially savvy, where actually they can afford this debt into retirement, where they might have good pensions, they might have good investments, they might also have buy-to-lets in the background, and maintaining that debt is more just part of the course, and they're happy to continue to manage that debt as well.
Is that something that you recognise as well, David?
Yeah, absolutely. I mean, when you look at the products that are available in this space, equity release has played a pivotal role in supporting those either approaching retirement or already in retirement in managing that debt.
There's definitely things I think we can touch on later as we move through the podcast and some of the things you've said there, David. But yeah, well, that must create a challenge for building a strategy in an advice business where things are shifting that much.
Absolutely, Paul. I think sort of building on what Nathan said, I think given the changing needs and profiles of customers in the later life space, it does put a great emphasis on having more comprehensive conversations as you go through the advice process. I think what we're seeing in our internal advice business is really two very distinct cohorts of customers. So as David said, you've got the sort of traditional equity release customers who are perhaps sort of well into their 70s. They've paid down their existing mortgage debt probably by the time they've retired. And then they're looking for equity release sort of partially through their retirement in order to boost their retirement income or to gift to family members or just to enjoy life a little bit more by going on that holiday of a lifetime or improving their home, whether that be a conservatory or a new kitchen or things like that. And that profile of customer still exists, and it's still a really important part of the market. But I think the challenge for both specialist later life lending advisors, but more pertinently maybe for mainstream mortgage advisors, is this new cohort of customers that are coming into the market who are in their early to mid 50s. They've still got a substantial amount of mortgage debt that they're carrying. And there's really no chance that they're going to clear down that mortgage debt before they retire. So there's an inevitability about them needing to carry that mortgage debt through retirement. And that's where advisors have a crucial role to play in helping them manage that mortgage debt and navigate perhaps through a different range of product solutions over the next 15, 20, 30 years. And that may be starting with traditional mainstream mortgage products that are designed for older customers. It may mean then moving into REO products, and ultimately maybe moving into lifetime mortgage products that allow them to serve some or all of the interest before moving into a full roll-up situation, maybe at the latter stages of their life. So that's a much more complex journey for an advisor to manage than was ever the case previously. And that's why I think advisors need that help, education, support that the likes of Air provide, but also where technology needs to improve in terms of sourcing solutions and tools to help them get to the right product outcome for each different customer's needs and circumstances.
Thanks, Will. And sorry, Nathan, you were going to come in then?
Yeah, and I think what you're saying there as well is it's that the customer base is changing significantly, but also it's important for all the advisors out there to really take on board all of the information that is available to them, open up the lines of conversations with the different types of providers, whether it be standard mainstream lenders as well as the equity release style products, and just have that conversation with those lenders and the support structures that are in place for them to understand the next steps as well, so that they can provide that holistic advice to their customers. And I think that is also a very, very key part in what advisors and the role they play really need to get on board with that and say, don't worry about asking the question. Educate themselves, and so that they can have that discussion, so they can ask the right questions to their customers to do a more holistic, long-term strategy for them.
Yeah, and we heard from some of our guests in previous episodes about broader thought leadership in the space and some of the emerging product types. So, David, just building on that conversation from Will and from Nathan, I think we heard Marie Catch in one of those episodes talk about the thought leadership from Legal & General in tackling the emerging trend for customers with debt in retirement. So, can you tell us about the role of equity release and others in terms of product development and at a product level for managing debt, and in particular the PTLTM product?
So I think we've already talked about, equity release has always played a very, pivotal role in helping those, I suppose, either in retirement or, as Will said, approaching retirement to manage sort of like debt. I think last year, 1 in 4 customers took a lifetime mortgage to repay an existing mortgage, and I think 1 in 3 took a lifetime mortgage to repay, some form of unsecured debt. And I think when you look at reports from the FCA where you have, almost 1 million outstanding interest only or part and part mortgage, one of 4 of those maturing in the next 5 years and almost 60% in the next 10 years, it's important that we continue to innovate in this space so that we can support those, sorts of customers. And we have recently launched our payment term lifetime mortgage. It's a product where customers can have access to higher LTVs, because we're seeing, since LTVs have compressed in the market, we need to find alternative solutions to be able to bring those back. And this product allows customers access to those LTVs in exchange for committing to making monthly interest payments. So with that product, the customer will decide with their advisor how long they want to pay for, up until the age of 75, dependent upon the income type that's being used in the affordability assessment. And one of the great things about this product is because they don't have to make their payments for the duration of the loan, it's easier for joint borrowers to pass an affordability assessment, because we don't do that first death stress that we do on the Rio product. And we've seen the product used in a number of different ways. So we've talked about interest-only mortgages, debt consolidation. We've seen it used for purchases. So, when you spoke about some borrowers are looking to sort of like improve their lifestyle, we've seen customers who have taken the product, which has enabled them to move into a product that gives them sort of longevity. And another example that we've got of where this product has really driven a positive outcome for a customer is we saw a gentleman who had a existing mortgage, a loan and a credit card. His outgoings were over £1,000, and we've managed to over half those. And that's really important when you consider the rising cost of living at the minute. So we've definitely been able to make that customer more comfortable as they transition into retirement.
And those are good examples of things we'd hoped would surface from what we in ERA term in comprehensive conversations. They're all affordability led. If you put affordability at the heart of the process, then opportunities to support customers in that type of scenario surface and drive great outcome or better outcomes. Nathan, is that kind of product innovation mirrored in the more mainstream side of the product landscape?
I mean, on the mainstream side of things, especially where we operate within the building society market, what we are looking at is exactly what you just mentioned there, where it's based on the affordability, and is this affordable, and can they continue to maintain this loan? And if they can, then why not? Why not look at it? If you are looking at customers who are struggling currently, or their outgoings have gone up that little bit more, and actually the right advice for them is potentially to look at these types of products, consolidate debts, or change the loan maybe from a repayment to an interest only for the meantime, because in 5 years' time their plan is to do this. Within the building society market as well, we are always open to the conversations and understanding the customer's needs. So in regards to product side of things, we can look at interest only later on in life, up to high LTVs with a credible strategy in place, rather than just going to the age-old side of things where you're looking at 70, 75, maybe 80. In that case, no, we're going to walk away from it. We're not interested in that case anymore. But why not take an overview of their whole circumstances as a client, as an individual, and then we can decide whether that product is suitable for them. And I think that's really where, although it may not be a product-specific innovation, it's going back to good old-fashioned lending of, is this the right outcome for the customer? Does this make sense? Right, in that case, let's find a way to help them and serve their needs.
Thanks, Nathan. And Will, does that sort of set of examples resonate with you from a specialist perspective, where you've got examples of being able to help customers successfully in terms of debt management in later life?
Absolutely. I think what both of the guys have sort of evidenced is that there are so many options out there for later life customers these days, whether it be in the equity release space or indeed in the sort of mainstream space. I think the phrase that still really annoys me more than anything is when I hear industry professionals talk about equity release being a product of last resort. And I think given the innovation we've seen in the lifetime mortgage space, that is absolutely not the case. So we shouldn't look across and see equity release naturally being a product that involves full roll-up of interest. As David outlines, we've seen innovations now over the last couple of years, whether it's for mandatory repayments or optional repayments, that allow customers to service some or all of the interest, either for some of the duration of their loan or indeed for the full duration of the loan. And that allows a customer to more actively manage their debt and makes the product suitable for a whole range of different circumstances. And we've seen customers right across the sort of wealth spectrum use the products very effectively to achieve their needs. So it could be a customer, as we say, looking at IHT mitigation strategies and how taking money out of their property today can help reduce the tax bill for their beneficiaries sort of further down the line. It might be someone using an equity release mortgage to settle a divorce, for example, which we're seeing more and more with sort of silver splitters. It could be someone taking out equity release to help fund the purchase of a lease on a freehold in order to own the freehold of a property. So there's a whole range of different ways that these products can be used. And I think not just specialist advisors, but mainstream mortgage advisors have to start thinking differently about this space and how these products can be used to support a whole range of different needs and circumstances.
So Will mentioned there the phrase product of last resort. So have either of you got examples of where you've come across cases and circumstances where that's not the case?
Yeah, I mean, I think in an increase in interest rate environment, we're definitely seeing a shift towards needs-based borrowing. But, I participated in some research recently where one of our customers had used the money that he had advanced to purchase a yacht. It had always been his dream to purchase a yacht. And his partner, was happy to fund that yacht through a lifetime mortgage as long as the interest was being serviced, which they could afford to do. And they've been able to achieve sort of like a lifelong dream.
So it does break the kind of misconception then, or preconception rather, that equity releases for those that are asset rich and cash poor. But Nathan, have you got any examples?
Yeah, and also from a more standard later life lending scenario is taking it back from the later life side of things. There's a lot of press at the moment of the overall affordability stress and strain for the younger borrowers. And actually what we are seeing is an increase and an uptake of joint borrower sole proprietor as an example, where to assist with the younger borrowers' affordability struggles, the older customers are willing to jump onto the mortgage, utilize their incomes to support that borrowing, where actually, as an aspirational family unit, they can really see the benefits of not just the younger person's income, but the older person's income as well. And it's not just thinking of that in the older borrower as an individual, it's actually looking at the combined family unit. So we are seeing parents coming on and going up to potentially the age of 95 to help them get, instead of a one-bed flat, a two-bed house. Longer term as well, it also saves them money financially because they then don't have to sell that property in 2 or 3 years' time when they have the little baby and actually want to go from a one-bed flat to a two-bed house and then have to put money into estate agency fees, stamp duty costs and all those things. And actually they get to move into that larger property straight away as more of an aspirational style product. So it's not just, like I say, the potential of product last resort. It's actually a potential product that can help people at the very beginning of their life, not just at the end.
And those two sort of case studies really excite me. Not because one of them had a yacht in it, but definitely because they're a chance to collaborate with other practitioners, definitely in that kind of yacht complex position scenario. But yours, Nathan, where it's intergenerational objectives. So you really build in embedded value in your business by being open-minded to how you can support multiple generations of customers. So it fascinates me that. But again, it comes from great conversation.
Yeah. Especially as you need to see of the increase of the bank of mum and dad and bank of mum and granddad, and that's that you see that in the press a lot. And the deposits are sometimes coming from them. And actually, does that deposit need to come from them, or could it just come from them topping up the income instead and actually keeping the money they were going to provide as an additional deposit in their own bank account, and actually makes it more comfortable for them as well? So there's a lot of conversations that can be had around that type of scenario.
Yeah, and just to add, I think from an advice perspective, I think one of the sort of challenges we're hearing back from advisors at the moment is a nervousness around customers wanting to proceed in the current rate environment. And it's right that customers are circumspect about that, and it's right that advisors are sort of making sure they're making measured recommendations about when it's not right to proceed. But I think sometimes we forget that these later life lending solutions can be very sort of lifestyle enhancing and aspirational, and actually the rate is for those customers is maybe a secondary consideration. I mean, why should these customers put their life on hold around those sort of ambitions they have, whether it be buying a yacht or helping one of their family members onto the housing ladder, or to make that next step up on the housing ladder? Those are sort of lifestyle sort of ambitions which you can proceed with in the current rate environment, and the new products allow customers to manage that debt in a cost-effective way. So I think advisors and customers should have that confidence about being able to move forward and to live their lives and dreams in the way that they want. And that's what these products can do. And, you know, in our advice business, we've got so many stories sort of like that around how these products are really changing people's lives for the better, and not just their lives, but family members' lives as well. So, you know, it can be a really sort of aspirational and life-fulfilling decision that these people are making, which sometimes I don't think is recognised by lots of people in the industry. So really good to hear those examples.
Certainly the value advice in that context. You know, there's been some great case study style examples from all of you there in terms of where, you know, products and solutions can support what seems to be a ever increasing emerging theme of as we said, people carrying debt into retirement. I think be interesting to just explore a little bit with the three of you what your organisations are doing to help advisors understand this a bit more, understand what they need to do in their businesses. So, Nathan, can I come to you first in terms of what support's available from your organisation?
Yes, certainly. I mean, we have a wider range of BDMs across the country, and they're always happy to take the call from the advisors to go through as much as they possibly want in regards to how they can structure these types of cases with us. We have recently launched our kind of education hub on the website as well, which will be continually updating and adding more information onto there. Podcasts such as this, to make sure that people are at least aware that these types of products and types of solutions are available. And we're always happy to have a conversation. I think that's the most important thing. Give us a call, go through it. The support is there. If you don't understand what you've got in front of you from an advisory perspective, send it over to us. I look through, when we're looking at cases, we can look at, as an example, investments, pensions, SIPs, SASs, drawdown facilities, which sometimes people don't know what they're looking at. So you can provide that to us up front, have an open conversation with us and say, well, what does this mean? What can I do with this? And we will come back and say, this is how we'd look at that. This is what we would do. And this is how you can structure that case. It's all about education, and it's all about just support overall. And I say that what I would say is our main kind of takeaway from that is we're always happy to have a conversation.
Is that the same for you, David?
Yeah, you know, it's a similar story. We've got a lot of information available on our advisor centre. You know, particularly from an innovation perspective, we're learning who's taking these types of products and how they're being used just as much as the advisor is. And as that evolves over time, we're creating new case studies and uploading those. But what I would encourage is if you do have a customer, or if you don't understand something about the product, reach out to your BDM. That's what they're there for. And we've got some exceptional BDMs at Home Finance. And even if, for example, it's just talking through the affordability of a case, because you know we've talked about how important that is. That they're there to help you. And if you can't get through to the BDM, call up our normal number, and we've got a concierge team that will also help with those particular affordability questions. So similar ilk, but yeah, that's what we're there for.
And Will, just coming to you, if thinking more about the business principle than necessarily the advisor looking for help on a case, if we're starting to see an emerging trend of needing to consider a broader set of circumstances, not necessarily jump to conclusions on customer profiles. There's this whole raft of emerging, more complex customers in the middle. What impact has that got for a business principal who's listening to this, thinking about what changes they need to make to their advice philosophy and their ongoing business strategy? Because it's going to be quite an important shift.
I think it's huge, Paul. And when I'm out there talking to business principals, or indeed the sort of heads of the large networks, I think there's two angles for me. One of which is sort of looking through the consumer duty lens and sort of highlighting that no matter whether you're a specialist later life lending advisor or a mainstream mortgage advisor, you can't ignore the fact that there are lots of different options available for customers in this market. Irrespective of the scope of advice you offer, consumer duty requires you to have a wider field of vision and to consider products or solutions that might be more appropriate for the customer than those that you offer. So I think it's important that in advice processes and philosophies that is taken into account, and advisors, businesses have that choice as to whether they expand the scope of their advice to include those propositions, or they have trusted referral mechanisms whereby those customers can be passed to another advisor who can talk about those solutions with the customer. So it's an area that, from a consumer duty and a regulation perspective, business principals just can't afford to ignore. However, that sounds like quite a sort of negative sort of take on it. I think the flip side to that conversation is also, as a business principal, this is an area of the market you can't afford to ignore for commercial reasons. So you look at the revenue opportunity in this market, and it's significant. And that comes for me in sort of two ways. Firstly, mainstream mortgage advisors are sitting on a database of customers who traditionally maybe they've stopped servicing those customers when they've reached the age of 55 or 60. And actually, there's a great opportunity to show the value of advice for those customers all the way through their life cycle. And indeed, not to just help them with their needs, but also then engage with them and talk to them about what their children or grandchildren might need in terms of mortgage advice as well. And it's a really sort of efficient way of bringing new business into your practice if you're sweating your existing database rather than having to rely on acquiring new customers day after day, week after week. And again, if you look at the opportunity in terms of revenue, a lot of customers maybe at the moment when they're remortgaging over the age of 50 are going into product transfers, which, as we all know, sort of have very poor levels of proc fees attached to them. Well, it's a sort of win-win for all sides if for some of those customers, these later life lending options can be considered. And not only is it delivering a better outcome for a lot of those customers, but it's also coming with an enhanced revenue attached to it for those firms and business principals as well. So again, whether it's from a regulatory perspective or whether it's from a commercial perspective, my message to people that are running mortgage businesses is that you just can't afford to ignore this space.
That's good advice, I think, that Will. I think, having listened to the comments from all of you, there's a definite recurring theme that there's plenty of opportunity out there for firms to engage with customers, plenty of opportunity for firms to engage in this kind of middle part of the market that's emerging, that definitely is carrying debt into retirement. But the only way you really surface those opportunities is through the comprehensive conversations taking place around what people have got in terms of in-depth income and expenditure conversations and what they can truly afford. And then only when you know that can some of the great designs and work that your organisations have been putting into play really come into effect. So just to kind of put you all on the spot a little bit, what would you like to see both in terms of advisor best practice or firm best practice and then product design from lenders over the next couple of years? Put you on the spot, Nathan, first.
That's a tricky one, isn't it? There's in regards to the advice process, I think, as we mentioned earlier, it does come back to that self-education and that understanding and not being shy to ask the questions and conversations. Where there are multiple times where I might get a phone call from an advisor asking about our later life lending products and policies. And sometimes the simple question that I'll have back, okay, so what pension contribution, what pensions do they have in the background? And they say, oh, I haven't asked that question. So initially it'll be those types of scenarios and not being shy to ask those questions up front, so that you can get a full understanding of that market as well. So that just a bit of a shift change in attitude, I think, is probably a good thing to have. I mean, it'd be nice to see, we've recently increased proc fees for product transfers so they get the same amount as if it was a brand new case. So it'd be nice to see that kind of changing. Although it's not product innovation, it will at least help those conversations where that customer may be looking at a later lifestyle product and will need to continue that debt in the future. So actually it benefits everybody long term for things such as that. In regards to product innovation, I think it'd just be nice to see everyone being able to not just look at the black and white of this is what we do, this is the income we'll take up until then, and being able to open up their criterias and their understanding of that type of market as well. Whether it be more versions of your products in a hybrid side of things, because what that product makes sense. Why wouldn't more lenders necessarily want to consider something similar to that? So again, I think it's everyone getting out of what we have done over the last 10, 15, 20 years as an example, and then just looking at moving forward, what needs do our customers, what needs are they going to serve moving forward, and actually being proactive about it and saying, right, this is what we can look to do moving forward. And just looking out of the constraints of what the norm is considered, because there's no such thing as a normal case anymore. Every case is now got more complexity to it, has got more needs for that customer, and it's being flexible and fluid and driving the business forward to support not just the company that they work, the bank or the building society that they work for, but also the needs for the ever-changing customer. And I think that's key, is, like I say, putting the customer at the center of what you want to do as a business is probably the most important thing.
Yeah, I agree with that. Some interesting thoughts there, particularly I'm sure the proc fee change will be welcomed by firms. But at Air, we'd wholeheartedly agree with that. Treat every customer individually, because we've been running a series of sessions on personalisation of advice, because, again, if you can do the best job you can for customers, then asking all the right questions, putting all the right inputs into our sourcing platform, for example, whether that's what the customer wants to pay and for how long in terms of serving the interest, or whether it's a full disclosure and input on all of their health information to make sure you've personalised the product from that perspective. All really important stuff. So we'd echo those kind of sentiments, Nathan. David, anything that you'd like to see in the next 2 years?
I think, we've talked about quality conversations. I think that's really important. I would say don't discount any products. There is a wealth of different types of products out there. It might be that some meet customers' needs and some just don't. Don't discount them. And you have to have those quality conversations, and you have to have that education and that product knowledge to be able to advise the best possible one for your client. From an innovation perspective, I think, we can't bring new products out every month. A lot of work and effort goes into them, but we shouldn't rest on our laurels once we have sort of bought a new product out. We need to listen to the feedback that we're getting from advisors. We need to listen to where it's worked for a customer and where it hasn't quite worked for a customer, and continue to evolve in a safe and responsible way, but with that really laser sharp focus on how can we support more customers and drive some really good customer outcomes.
Yeah, thanks for that. And I think the don't discount products resonates with me, because if we are going to support customers keeping their options open for as long as possible, then it is those affordability-led conversations that keep as many product options on the table for as long as possible during the advice process.
Absolutely.
So agree with that. Will, some final thoughts from you in terms of what you'd like to see in the next 2 years?
Just building on what the guys have already said, I think for me in the advice space, what I'd like to see is a breakdown of the silos that exist between the two markets. So whilst we'll always have specialist later life lending advisors, we need to have those advisors be more aware of the options that are available in mainstream, consider those within their advice process, or refer if they don't cover those within their own scope of advice. And the flip side is we need the same from the mainstream mortgage advisors. They need to have a good enough understanding of the options available in the lifetime mortgage space. So again, they can refer customers where appropriate to a specialist advisor. So those silos need to be broken down. I think where the sort of support services market can help that process, and I'm looking at AIR in particular clearly, is around how sort of sourcing solutions can come together. So how mainstream sourcing and later life sourcing can merge to help advisors have a more holistic view sort of across the piece. So I think there's a technology development requirement there to really help support that sort of more holistic advice process. And on the product side, and David may want to respond to this, but I think we've seen huge amounts of innovation as we've already talked about, and I think we can't expect that to sort of continue every week. But I think the one area which is holding back the market slightly at the moment from a lifetime mortgage perspective is on early redemption charges. I think at the moment we're seeing a lot of customers and advisors sitting on their hands because they're worried that we're at a peak in the rate cycle, and that they don't want to have sort of buyer's regret of signing up for a long-term fixed rate product that is when rates are going to fall in the sort of short to medium term. So if we could see some innovation on ERCs so that customers would have more optionality going forward if rates change, I think that would be a bit of a game changer. And I know that's quite difficult from a sort of funding perspective, and it may come with sort of additional sort of rate premiums initially, but I think that's something that advisors and customers sort of would value and would understand if there was more innovation in that space. So that's just a few ideas from me, Paul.
Thanks, Will. And thank you to all of you for your thoughts. I think just reflecting on our conversation in terms of a bit of a recap, my takeaways are that there is definitely a movement of new customer where attitudes to carrying debt into retirement are changing. I think, Nathan, you talked about pension income and other more stable forms of retirement income definitely giving people that option. We've heard in some of our other sessions around the use of new product types, and David, you've given us some great case study examples there of where real life examples where customers have been helped, but it does mean solutions and debt being carried into retirement. So affordability led conversations are crucial to surface those types of customers. And then, Will, you talked about the need to think through the implications on the advice philosophy. So there's good food for thought there for business principals that are listening or watching this podcast as we've moved through it. But it sounds like it's a fantastic area to explore further in later issues. Brilliant opportunity for businesses and a brilliant opportunity to really, really do what advisors do best, which is help serve the needs of customers who are desperately in need of some financial advice and support, and being the bridge to some great product design that you've outlined, David, and that you've outlined as well, Nathan. So thank you for your time today, and we'll speak to you soon.
Thank you.
Thank you.
Thanks for listening. If you enjoyed this episode, please take a moment to rate and review us on your favourite podcast platform. Your support helps others discover the show. Don't forget to subscribe so you never miss an episode, and follow us on social media for exclusive content. We'll be back next week with another great comprehensive conversation.